Welcome to the deep dive.
Good to be here.
Today, we're diving into a really dramatic story. Opendoor Technologies. That's NASDAQ. Open.
Oh, yeah. Opendoor. It's been quite the ride for them.
Totally. A real roller coaster, from the darling of the SPAC boom
Mm-hmm.
to becoming this, symbol of tech overreach. It saw these huge swings, didn't it, through the hot housing market, and then...
And then the crash when rates went up. Brutal.
Exactly. And now they're about to report Q2 2025 earnings. That's on August 5th.
Right. And the big question everyone's asking, the sources are all over it, is this really an inflection point? The long-awaited one.
Or is it just another kind of brief rally, another blip in what some see as a broken story?
That's the core of it, that disconnect.
Yeah, it's fascinating because you've got Wall Street, broadly speaking, still looking at Opendoor and seeing, well, frankly, a house flipper that's struggling.
But then you have this one very loud bull,
Yeah.
Eric Jackson over at AMJ Capital.
Right. And he sees something completely different. He sees a tech platform ready for a major re-rating.
So our goal today, really, is to pull out the key insights from the material, help you make sense of this potentially pivotal moment for Opendoor.
We'll look at that recent stock surge, try to understand why Wall Street's still so skeptical.
Then we'll unpack this Opendoor 2.0, the strategic reset.
We've got to look at the actual operational progress, too, the measurable stuff.
Definitely. And dive into Eric Jackson's thesis, his track record, which is pretty impressive.
Huge market opportunity to discuss as well.
And that critical milestone, EBITDA break-even, plus the risks, with priced in what maybe isn't.
Okay, let's jump right in. The stock price, it's been, well, nuts. Up over 200% in the last month alone.
Yeah, it's been parabolic. And look, let's be honest, a big chunk of that is probably short squeeze action.
Right, the classic setup. Investors betting against it get squeezed, forced to buy back, pushes the price higher.
Snowball effect. Oh, plus, renewed interest from retail traders. That's definitely playing a role.
But this is where Eric Jackson comes in, saying, hold on, this isn't just another meme stock bounce.
Exactly. He thinks there's something more fundamental happening underneath all that froth.
Okay, so he's bullish, but Wall Street, not so much. What are the analysts saying?
It's a stark contrast, really.
Yeah.
The general feeling on the street is still pretty bearish. You look at the consensus price targets, Goldman, UBS, Citi,
Where are they?
clustered around like $1.30 to $1.55.
Wow. That's, what, 40% below where it's trading right now?
A full 40% lower. Yeah, that tells you something.
And that pessimism, it's baked right into the valuation, isn't it?
Oh, absolutely. It's trading at less than 0.3 times trailing revenue.
Right.
0.3.
Which is low.
Very low. It's the kind of multiple you see on businesses the market thinks are, well, broken. Structurally impaired is the term often used.
Ouch.
But see, Jackson's point is if Opendoor actually becomes this tech platform, leverages that model,
Yeah.
that multiple could expand massively, like 10 times or more. A total re-rating. That's the scale of the potential upside he's pointing to.
Okay, so that's a huge potential difference. You've got these super low expectations, a hammered valuation,
Right.
but this potentially significant milestone coming up very soon.
Exactly. And maybe that disconnect is the opportunity. Opendoor's Q2 guidance is for positive adjusted EBITDA, somewhere between $10 and $20 million.
Which would be the first time in how long?
Nearly 3 years, their first operational profit in almost 3 years. A huge turning point if they hit it.
So, yeah, low bar, beaten down stock, but maybe, just maybe, a catalyst on the horizon.
That's the setup.
Okay, so let's address that perception issue. The tech-enabled house flipper label. The sources say, today's company looks very different. What's the shift? What's this Opendoor 2.0 actually about?
Right, because, yeah, early on, it was mostly about iBuying, flipping homes quickly. Volume was key. But the strategic shift now is, it's profound. They're not just chasing volume. They're building what they call a vertically integrated transaction engine.
Okay, vertically integrated. What does that mean in practice? Give us some examples.
So one thing is their Key Connections program. It's a nationwide agent referral network.
How does that work?
Basically, if a seller comes to Opendoor, but Opendoor decides not to buy the house.
Which happens a lot more now, presumably.
Right, they're more selective. But instead of that lead just dying, they refer the seller to a partner agent and take a referral fee. They're monetizing leads they don't even transact on directly.
Ah, okay, so turning a no into revenue. That's clever.
That's pure platform thinking. Then there's Cash Plus.
Cash Plus?
Yeah, it gives sellers the certainty of Opendoor's cash offer, but also lists the home on the open market for a period, trying to get the best of both worlds.
Interesting. Certainty plus potential upside.
Exactly. And then they're bundling in other services, financing, warranties, title insurance, digital closing,
Yeah.
all integrated into the app.
Right, trying to capture more revenue from each transaction.
Each one has a higher margin revenue stream than just the flip itself.
So it sounds like the goal isn't just to get better at flipping houses. It's almost like they're abstracting the flip itself.
That's a great way to put it. They're making the transaction, the buying or selling, the entry point, like a Trojan horse.
And the real money or the bigger opportunity is in everything around that transaction, the platform services.
That's the core idea. This model, if it works, should lead to much higher margins, more resilient revenue streams.
Compared to just the thin margins and volatility of iBuying.
Precisely. It's about leveraging the infrastructure they built for iBuying into something potentially much more valuable and stable. Kind of ironic, isn't it?
It is. Okay, so that's the strategy. But talk is cheap. Is this translating into actual measurable progress? You mentioned the reset.
No.
What's happening under the hood?
Yeah, beyond the meme stock stuff, there's been a very deliberate, measured margin-first reset over the last 18 months or so.
Meaning
Slashing costs significantly, rethinking how many homes they buy and when, rebuilding the whole transaction strategy.
and we're seeing this in the financials.
We are. Operating expenses, for example, down 33% year over year. That's huge. Q1 adjusted EBITDA loss was only $30 million. Still a loss, but compare that to $50 million loss the year before. Big improvement.
And operationally, like how quickly are they turning over houses now?
Getting much tighter. Holding periods are shorter. The spreads, the difference between buy and sell price plus fees have improved. Inventory turnover is down to an average of just 120 days.
So it sounds like a real shift towards sustainability, not just growth at any cost, like back in 2021.
Exactly. It's a stark contrast to that sort of reckless growth phase. Discipline is the focus now.
Okay, let's bring Eric Jackson back into this. We talked about his bullish stance. Remind us about Opendoor's valuation roller coaster.
Right. So peak SPAC hype, February 2021, it traded at a premium 5.1 times forward EV to revenue multiple.
Wow.
Then the crash. By October 2022, it was below 0.1 times.
0.1, almost unbelievable.
Totally wiped out. And even now, after this massive rally, it's still only around 0.4 times forward revenue.
And Jackson looks at that 0.4x and thinks,
He thinks the re-rating has only just begun.
and his track record gives him credibility here, right?
Yeah.
Tell us about E&J Capital and these calls he's made.
Yeah, his record is frankly quite remarkable. He talks about making 100-bagger calls investments that returned 100 times over 15 years.
Like what?
Well, he was in Alibaba way back in 2009 when it was still private. He called Satya Nadella getting the Microsoft CEO job 6 months before it happened.
No kidding.
Yep, early in Roku, Twilio. More recently, he was calling Carvana again at $11 last year.
After its own near-death experience.
Right. Coinbase at $38, Uber around $44. And he's been involved in some deeper tech names too lately. DeFi Technologies, BTQ, Cipher Mining, Iris Energy, making calls at very low entry points.
And his call on Opendoor, when did he make that?
He publicly called it a generational opportunity early this year, 2025. Said he bought in around the 73 cents share.
73 cents. Okay,
Yeah.
so what's the bedrock of his conviction now? Why Opendoor? Why now?
It really boils down to two core beliefs for him. First, simple survival. He believes the company gets through this housing downturn.
Okay, step one.
Step two, and this is the big one, is that this evolution into a transaction platform justifies a much, much higher multiple. He's talking 4 to 5 times forward revenue.
Like a Carvana or an Uber multiple, basically.
Exactly. He sees parallels there. His sort of edge seems to be spotting that operating leverage before Wall Street wakes up and re-rates the stock. He looks for that moment when improving unit economics just break the old assumptions.
It's still hard to picture that kind of scale, though. You said back in 2021 they bought over 15,000 homes in a quarter.
Right, they were huge.
And Q1 this year, just over 3,600. That was a strategic retreat, sure, but still. How big is the pond they're fishing in now?
Well, the pond is enormous. The U.S. housing market, we're talking over $2 trillion in annual transaction volume. Trillion with a T.
Okay, that's a big number.
The insight isn't just the size, though. It's how this new platform model could tap into it. It's not just about the home sale value anymore.
Right, it's about the services around it.
Exactly. So the long game thinking is, if Opendoor can capture even just 1% of that $2 trillion market,
Okay, 1%.
and if they make, say, around $5,000 in revenue per transaction from all their bundled services, the referrals, the title, financing, etc.,
Yeah.
that alone could generate $20 billion in annual revenue.
20 billion. Wow. just from the services layer on 1% market share.
That's the potential scale. The analogy used is becoming the Stripe or Shopify of residential real estate, owning the transaction, not necessarily the homes.
That's a powerful analogy, Stripe for housing.
And it's a story, a scale potential that very few investors seem to be modeling right now. It's a potential blind spot.
Okay, so if they hit this positive adjusted EBITDA in Q2, that's a huge signal. But let's be clear, we're not talking GAAP profitability, are we?
No, definitely not. That's a
Yeah.
crucial distinction. GAAP profit isn't really expected this year. They lost nearly $400 million on a GAAP basis in 2024.
And analysts don't see actual net income until when? 2027.
Yeah, 2027 is the earliest consensus forecast for true net income. But markets often care more about the direction of travel.
The trajectory.
Exactly. So hitting positive adjusted EBITDA, that first operational profit in almost 3 years, that signals they've maybe, just maybe, regained control of the model. That's symbolically huge.
But you can already hear the bears, right? What will they say if Opendoor does post positive EBITDA?
Oh, for sure. Jackson himself anticipates this. He says the bears will likely call it a fluke.
A one-off, driven by seasonality or something.
Yeah, exactly. They'll predict losses will return in the weaker quarters, Q3, Q4. They'll argue the fundamental model is still broken.
Just like they did with Carvana and Uber.
That's Jackson's comparison.
Yeah.
He argues they made the same "it's still broken" arguments about those companies right before they inflected.
So for him, this Q2 report isn't about proving the model is perfect overnight.
No, it's about exceeding the low expectations, showing positive direction, and reinforcing that long-term platform play. Especially if you layer in potentially falling rates, maybe rising housing volumes eventually, more adoption of Cash Plus, even future international expansion maybe.
Right. It's about the narrative shift. Okay, but we have to talk risk. What could actually derail this bull thesis? Because it's not guaranteed.
Absolutely not. And the risks are real. Housing volumes could stay sluggish for longer if rates remain high. That's a headwind.
Okay.
JAP profitability is still years away. That requires patience.
And inventory risk. They still hold houses.
They do. It's reduced, but it's not zero. So they still have exposure to housing price fluctuations, albeit less than before. And dilution risk is always there if they need more capital before growth really accelerates.
So sluggish volumes, no gap profits soon, inventory exposure, potential dilution. These sound pretty serious.
They are serious risks, but here's the critical point Jackson makes, and the sources echo this.
What's that?
These are not unknowns. The market already knows all this. These risks are arguably already priced into that super low valuation.
Okay. So the opportunity isn't in ignoring the risks.
No, it's in what's not priced in.
Which is?
Sustained operational momentum. The actual proof that this shift to a scalable, tech-first platform model is working. That's what the market isn't fully buying yet.
So what the critics are missing, potentially, isn't that Opendoor is unprofitable or has risks.
Right. Everyone knows that. That's priced in.
What's not priced in, according to this view, are things like consistently improving spreads and turnover times.
Exactly. The increasing contribution from those adjacent higher margin services.
And the potential for Opendoor to really become this transaction layer business, not just a slightly better house flipper.
That, Jackson says, is the delta. That's the gap between the current perception and the potential reality.
What a turnaround story, if it plays out. It's clear Opendoor has gone through some major surgery, really retooling the business.
Yeah, for long-term resilience, it seems, not just that hyper-growth phase. Cost-cutting, redesigning the go-to-market, expanding the products.
And now, potentially, on the cusp of positive adjusted EBITDA.
Look, the Q2 earnings report, it's probably not going to be some giant mic drop moment that silences all critics instantly.
More like
a potential tone shift. A significant one, perhaps.
And if they show that continued momentum, that clearer path towards profitability,
then the market might just start to revalue Opendoor, not as that busted flipper,
but as this ambitious digital transformation play in housing.
Exactly. One of the most ambitious, potentially.
And if that shift in perception takes hold, well, today's $2 stock price might look very different in hindsight. Could be the bottom, not the top.
It's possible. It really makes you think.
Yeah.
What specific signs would you, listening now, look for? In the housing market, in Opendoor's execution, what would confirm for you that this transformation is real? And how could that change how we all think about buying and selling homes down the road?
Definitely something to ponder. We'll be watching those Q2 results closely.
Absolutely. Should be fascinating.